Welcome to this explainer on the Banking SDLC, going from legacy bedrock all the way to AI-driven agility. Hey, if you've ever wondered why your traditional bank takes like 6 whole months just to update a single button on their app, while a neobank seems to launch a brand new AI feature every single Tuesday, well, you are exactly in the right place. Let's dive right in. We're going to follow the hero's journey of code across 5 distinct stages today. First, the constrained innovation game. Next, legacy bedrock versus modern agility. Then discovery, strategy, and compliance. After that, controls, testing, and exceptions. And finally, release and maintenance. So let's kick things off with stage 1, the constrained innovation game, and how banks use the software development lifecycle to hedge against systemic risk. Check out this immediate contrast in goals. If you're building the next big social media app, your traditional product manager is optimizing for maximum engagement, speed, and session time, right? But in banking, a fintech PM optimizes for survivability, failure containment, and auditability. And why is that? Because the massive hiring boom we've seen in fintech infrastructure, it isn't just a bet on growth. It's actually a hedge against systemic risk. Think about it. If a social app crashes, you just refresh your feed, no big deal. But if a bank's ledger fails, you trigger this massive cascade of false overdrafts and regulatory reporting events. In this world, survivability literally is the ultimate key performance indicator. Now take a look at this 150-pound figure. This is the staggering pound per pixel cost that traditional incumbent banks spend just to maintain and acquire a single customer. Compare that to a mere 20 pounds for agile neobanks. For a long time, incumbents got away with just throwing massive piles of cash at their bloated technology budgets, mostly thanks to economies of scale. But, as digital disruptors keep eating into their market share, that legacy cost model is becoming completely unsustainable. Let's move right along to stage 2, legacy bedrock versus modern agility, or as I like to call it, escaping the 40-year-old mainframe. Looking at this timeline, you really start to see the massive technology gap we're dealing with. Crazy enough, at their core, a lot of traditional banks are still running on COBOL-backed digitized ledgers that were literally built in the 1980s. Fast forward to the 2010s, and they tried a bit of a Band-Aid fix by virtualizing those mainframes, basically just copy-pasting the old, rigid system onto modern virtual machines. But today, escaping that bedrock requires a massive leap. We're talking about utilizing AI strategic assistants like Google Gemini for requirement drafting, leaning on GitHub Copilot for vibe coding, modern cloud-native architectures, and just shifting away from manual processes entirely by 2026. And this technical gap, it translates directly into customer experience and operational velocity. Fintechs offer digital onboarding in minutes with real-time AI personalization. Traditional banks, they often require you to physically visit a branch during your lunch break just to sign a piece of paper. Because they have this modern foundation, neobanks can deploy new code tens of times a day, literally every single day. Meanwhile, the incumbents are popping champagne if they manage to pull off a successful release just once a month. All right, on to stage 3, discovery, strategy, and compliance. This is all about getting over the compliance hurdle. I absolutely love this quote because it perfectly captures the reality of the banking software development lifecycle. The PM is the translator between legal's no exposure and engineering's we need 6 months. In fintech, you don't really just own a roadmap. You steward it through intense, heavy layers of control. Compliance isn't just red tape that you deal with at the end of a sprint. No, it is a core product feature. If you propose, say, a frictionless one-tap international money transfer without fully addressing the anti-money laundering exposure, your feature is totally dead on arrival. So to survive this phase, modern teams really have to embrace Agile 2.0 practices. This means running dual-track Agile, where your discovery and customer research are happening right in parallel with the coding. But step 3 here is where it gets highly specialized, mapping user stories directly to the general ledger. In banking, financial system literacy is absolutely mandatory. A developer or a PM can't just look at a money transfer as a simple user journey. They have to understand the sequence of hold states, reserve allocations, and exactly how it impacts the ledger. If you don't speak the language of finance, your code will simply never survive an audit. This brings us to stage 4, controls, testing, and exceptions. Basically engineering for the absolute worst-case scenario. Okay, here is a truly surprising truth about banking tech. Exception rate reduction is your true north. Delivering a flawless control document and reducing the number of false positives in your fraud detection systems, that is going to get you promoted way faster than shipping a shiny new UI feature quickly. When a regulator inevitably knocks on your door, trust me, they do not care about your agile velocity. They care about your audit trail completeness. See that number, $5 to $25? That is the actual hard cost of Know Your Customer and anti-money laundering compliance per user today. Just think about that for a second. When you realize that 30 to 60% of users might actually fail or drop out of an onboarding funnel, that initial customer acquisition cost completely skyrockets. It shows exactly why failure in the onboarding funnel absolutely destroys a bank's unit economics. To combat these massive compliance costs and operational drags, forward-thinking teams are fundamentally changing how they handle risk. They're deploying machine learning and AI to augment alert prioritization. By scoring AML alerts based on their actual likelihood of being suspicious, they can improve a compliance analyst's productivity by an incredible 30 to 50%. And they do this without having to dangerously lower their security thresholds. It's a massive, vital shift from rigid legacy rules engines to continuous AI model retraining. And finally, we arrive at stage 5, release, maintenance, and keep the lights on. This is all about navigating the real world. Just look at how drastically the standard has shifted in only a few short years. Back in 2022, a 24 to 48-hour end-of-day batch processing cycle for back-office reconciliation was totally acceptable. But today, with real-time payment rails like FedNow and UPI, the expectation is under 1 hour. If a customer sends money instantly, but your back-office reconciliation takes a full day to catch up, that isn't just a quirky operational delay anymore. It is a massive customer experience failure. Now, this chart right here, this is the heaviest anchor weighing down legacy banks today. A staggering 70% of their IT budgets are burned just keeping the lights on. They're spending a fortune managing immense tech debt and maintaining those aging estates we talked about earlier. That leaves a measly 30% for genuine innovation, which obviously puts them at a severe disadvantage against leaner, much more agile fintechs. So how do they break free? The future is Agile 2.0. We're talking about adopting AI-driven project management and DevOps at scale. This means using tools like Jira Align for predictive risk management across huge portfolios, and GitLab to enforce continuous integration and delivery pipelines with completely immutable audit trails. Success in this new era also means rigorous incident postmortems to maintain credibility with regulators. Ultimately, the goal is to move entirely away from measuring success by the sheer volume of code deployed, and instead focus relentlessly on driving actual business outcomes. I want to leave you with this provocative question to reflect on. Look at your own teams and processes right now. Is your software development lifecycle built just to build software? Or is it meticulously designed to survive the intense, high-stakes, heavily regulated ecosystem of modern finance? Because as we head toward 2026 and beyond, survivability really is the only metric that guarantees you get to keep playing the game. Thanks so much for joining me on this explainer, and I hope it completely changes the way you look at the tech powering your wallet.